Hello and welcome everyone. My name is Yasser Gulfraz and I'm your tutor for finance and accounting. Today we will discuss about interpret what do you finance be able to interpret financial statement, how to interpret financial statement, and we will discuss about ratios, profitability ratio, liquidity ratios, solvency ratios, valuation ratios, financial audit, historical audits, accounts, and financial audits. Our today's lecture on understanding financial statements. Anybody can hear me? Is there anyone? Anyone is there? Okay. Our lecture on understanding financial statements. So financial statements are most essential documents that provide insight into the financial health and performance of a business. So in this lecture, we will cover the basics of financial statements and discuss how to interpret them effectively. Understanding financial statement is key of making informed business decisions and assessing the financial health of a company. By analyzing income statement, balance sheet, and cash flow statements, you can gain valuable insight into a company's performance and make sound financial judgments or decisions. Also remember that use tools like horizontal analysis, vertical analysis, and ratio analysis to interpret financial statements effectively. So also we will discuss about ratios. We'll cover ratio financial audits, historical audits, accounts. Ratios are important tools or for evaluating a company financial performance, including profitability ratios, liquidity ratios, solvency ratios, valuations ratios, and also financial audits, historical audit, and audited accounts. Financial audits ensure that accuracy and reliability of a company's financial information, while historical audits accounts provide valuable insight into a company's past financial performance. Yeah, so next is key terminology. What do you mean by interpret financial statements? Anybody can tell me or explain me what do you mean by interpreting financial statements? Interpreting financial statement is the process of analyzing and appraisal of the performance and position of an entry. So in these reports, financial statement is the process of analyzing and understanding the information presented in a company's financial reports. These reports, such as the income statement, balance sheet, and cash flow statements, provide a summary of a company's financial performance and position. To interpret financial statement, we need to examine the numbers and data presented in these statements and analyze their significance and implications. This involves assessing the company's profitability, liquidity, solvency, and overall financial health. So let's go through a key steps involved in interpret financial statement. First, it is important to understand the components of financial statement. The income statement shows a company revenue, expense, and net income over a specific period. The balance sheet present a snapshot of a company's assets or liabilities and shareholders' equity and specific points in time. The cash flow statement provides income information about cash flows and outflows during a given period. So we analyze trends by comparing financial statements over multiple periods. By doing this, we can identify patterns and trends in the company's financial performance. This helps us assess the company's growth rate, profitability, and financial stability over time. Sorry about that. There was some issue. So what do you, next one is financial ratios plays, next is financial ratios, assessing ratios. Financial ratios plays a central role in assessing a company's performance. These ratios are calculated by dividing one financial statement item by another, such as gross margin or net profit margin. They provide valuable insight into a company profitability, liquidity, and solvency. So by analyzing these ratios, we can determine how efficient a company, how efficient a company's profit performance. Assessing these ratios are calculated by divided one financial statement item by another. So such as gross margin or net profit margin, they provide valuable insight into a company profitability, liquidity, and solvency. By analyzing these ratios, we can determine how to sorry. So assessing ratios. So by analyzing these ratios, we can determine how efficient a company is, its ability to meet short-term obligations, its and its overall financial strength. To gain a better understanding of a company's performance, it is essential to compare its financial statements to industry benchmark or competitors' performance. This comparison allows us to identify areas of strength or weakness and provide context for evaluating the company's performance relative to its peers. It helps us gauge whether the company is performance better or worse compared to others in the same industry. Financial statements also helps uncover potential risks. Here, identifying potential risk and opportunities. So, uncover potential risk and opportunities for a company. By examining the financial statements, we can identify areas of financial inefficiency, excessive debts levels, declining profitability, or positive trends like increasing sales or improving margins. These insights help us assess the company's future prospects and make decisions accordingly. Investors, lenders, and other stakeholders greatly benefits from interpreting financial statements. It empowers them to make informed decisions regarding investments, credit worthiness, valuation, and strategic planning. By understanding a company's financial performance, stakeholders can evaluate its potential for growth, determine its ability to repay debts, and assess its overall value in the market. So, calculate financial ratios from a set of business accounts. So, financial ratios are useful tool for understanding company financial performance and position, as we discussed. So they are calculated from the information provided in the company's financial statement. Financial from the financial here are some of the most common financial ratio. So now we are going to discuss some of the ratios. So first of all is liquidity ratio. There are two type of ratios, current ratios and quick ratios. So how to calculate them? The ratio, current ratio, how to calculate them? So current ratio, the ratio shows the company's ability to pay its short-term debts. It is calculated, sorry. It is calculated short-term, it is debts. It is calculated by dividing current assets like cash, inventory, and accounts receivable by current liabilities such as loans and accounts payable. Then it's a quick ratio. Quick ratio, acid dash test ratio. This ratio measures the company's ability to pay its short-term debts without relying on inventory. It is calculated by subtracting inventory from current assets and then divided by current liabilities. Profitability ratios, gross profit margin. This ratio indicate how much profit company generates from its revenue after deducting the cost of goods sold. It is calculated by dividing gross profit by revenue. Net profit margin. This ratio shows the percentage rest profit, the percentage of profit a company earns from its total revenue after deducting all expenses. It is calculated by dividing into profit by revenue. So then efficiency, return on equity. This ratio measures how effectively a company utilizes its shareholders' equity to generate profit. It is calculated by dividing net profit by equity. Then is efficiency ratios. There are three types of ratios: inventory turnover, receivable turnover, and pay turnover. So first of all is inventory turnover. This ratio measures how quickly a company sells its inventory. It is calculated by divided the cost of goods sold by the average inventory. Then receivable turnover. This ratio shows how many times a company collect its accounts receivable in a given period. Okay, so it is calculated by if you can see here, a net credit sale by the average divided by the average accounts receivable. So then is a third one is a payable turnover. This ratio indicates how quickly a company pays its suppliers. It is calculated by dividing purchases by the average accounts payable. These ratios provide valuable insights into a company financial health. These ratios provide a valuable insight into a company's financial health, such as its ability to meet short-term obligations, profitability, and operational efficiency. Any questions so far? Anybody? Hello, any question? Okay, so now is leverage ratios. Leverage ratio, the first one is the debt ratio, which tells us the proportion of a company's total debt compared to its total assets. It helps us understand how much of the company's assets are financed by debts. Then it's a liquidity ratio, which reveals the portion of a company's equity or ownership in relation to its total assets. This ratio helps us gauge the company's financial stability and how much of its assets are funded by shareholders' investments. So another important ratio is debt to equity ratio, which shows us the amount of debts company has in relation to its equity. It helps us evaluate the company's reliance on debts financing and its financial risks. Any question or anything else? Okay, so let's move to the onto market value ratios. So there are two type of market value ratios. Anybody knows about market value ratios? Okay, so the first one is earning per shares, which tells us the company's net income divided by the number of shares outstanding. It helps us understand how much profit each shareholder represents. Next one is a price earning ratio. Price earning ratio is another important ratio. It compares the market price per share to earnings per share. This ratio is widely used to investor to assess the valuation of company's stock. It gives us an idea of how much investors are willing to pay for each dollars of earning. So these ratios offer various insight into a company's liquidity, profitability, efficiency, leverage, and market value. Here are some examples of ratios. So let's say you have the following information from a business financial statements, like current assets 10,000, current liabilities 5K, gross profit 15K, revenue 50,000 pound, net profit 10,000 pound, equity 40. So you could calculate the following ratios to calculate current ratios. Current ratio, as I explained, the ratio help us understand the company's ability to meet its short-term obligations. It's calculated by divided current assets by current liabilities. So here you can see current assets divided by current liabilities. Gross profit margin is this ratio. As I explained, that indicate the profitability of a company's core operations. So it is calculated by gross profit by revenue. So here is the gross profit margin, which is 15,000 divided by 15,000, which equal 0.3 or 30%. Then net margin value. This ratio measures the overall profitability of the companies after considering all expenses. So it is calculated by dividing net profit by revenue. So net profit 10,000 pound and by revenue, which is 50,000, so is equal to 0.2 or 20%. So then is he's calculating return on equity. As I said, this ratio shows how effectively the company is using its shareholders' equity to generate profits. So it is calculated by this ratio is calculated by dividing net profit by equity. So here the returns on the equity is 10,000 pound dividing by 40,000 pound, which is equal to 0.25 or 25%. This means that of every £1 of equity the companies generate, 20% is net profit, or 0.25. So here is a difference between ratio. I've already explained you what is the different and what are different ratios. So I think so. Where is gone? So yeah. So compare organizational performance using historical financial data. Uh, Comparing organizational performance using historical financial data involves analyzing past financial statement, using various financial metrics and ratios to identify trends, changes, and areas of strength or weaknesses. This process, often referred to as trend or time series analysis, can provide valuable insight into a company financial health and its ability to achieve its strength objectives. So, for example, we have the following net profit margin and return on equity data for ABC company over the last 5 years. So, ABC company's net profit margin and return on the equity for the past 5 years, 2019 till 2023. Net profit margin is a financial metric that shows the, as I explained again, financial metric that shows the percentage of each dollar of revenue that translate into profit. It reflects the company efficiency in managing cost and generating a profit. So in this case of ABC, in the case of, in this case, the net profit margin has shows a consistent upwards trend. Okay, so 10, 11, 12, 13. So the net profit margin consistent upward trends over the 5 years period. It increased from 10% in 19, then 13% in 2023. So this suggests that ABC company has been able to improve its profitability by effectively controlling cost and increasing revenue. So in other hand, return on equity or on equity measures a company ability to generate a return on the investment made by its shareholder. It indicates how efficiently a company utilize its equity capital to generate profit. For ABC company, the return on equity ratio has also demonstrated a positive trend. It rose from 12% to 16% in. So it was equity return on equity was in 2019 it was 12%, and in 2013 it was 16%. It is 16%. So indicating an 12% in 19 to 16% in 2023, indicating an improvement in the company's profitability and efficient utilization of shareholders' investment. So here again, now we will focus on two key metrics: net profit margin and return on equity. So net profit margin, this ratios shows us the proportion of revenue that translate into profit. Like for ABC company, the net profit margin increased from 10% in 2019 to 13% in 2023. This is a positive indication, suggesting that the company has become more profitable and efficient in covering its revenue into profit. Next is a return on equity. This ratio measures how effectively the company utilize shareholders' equity to generate profit. In this case, the ROE, or return on equity, has generally improved from 12% in 2019 to 16% in 2023. This implies that the company has been successful in enhancing its efficiency in utilizing equity to generate profits. Here, take the past statement of Coca-Cola. If you want to see or visit, you can go there and Investopedia, and you can see the past statement of Coca-Cola company. Profitability ratios. Now, he's discussing about profitability ratios. Anyway, we'll go in depth bit, but we already discussed. Profitability ratios are financial tools used by analysts and investors to assess how well a company generate a profit in relation to its revenue, expenses, assets, and equity within a specific time frame. These ratio helps us understand how effectively a company utilize its resources to make a profit. So let's discuss type of profitability ratios. Gross profit margins. This ratio reveals a company's profit profits before considering operating expenses, interests, and taxes. To calculate it, we subtract the cost of goods sold from the revenue and then divide the result by the revenue. The outcome is expressed as a percentage of sales and provide insight into efficiency of a company production's process. So formula is operating profit margin is equal to operating profit or revenue. So then anybody can tell me what is operating profit margin? Okay. Operating profit margin, also known as operating margin. This ratio measures a company profitability, its core operations before interests and taxes. It is calculated by dividing the operating profit revenue minus cost of goods sales and operating expenses by the revenue. See, the operating profit margin help us understand how well a company manages its operational cost. The formula is operating profit margin is equal to operating profit or revenue. So next is net profit margin. This ratio represents the percentage of a revenue that is profit after all expenses, taxes, and costs have been deducted. It is calculated by dividing net income by revenue. Next is profitability ratio. Profitability ratio that can help us understand how well a company is performing financially. These ratios gives us insight into how efficiently a company uses its resources to generate profit. Comparing these ratios with other companies in the same industry or the company's historical performance can provide valuable information about its financial health and operational efficiency. The first ratio we will look at is return on assets. This ratio indicates how efficiently a company is using its assets to generate profit. It is calculated by dividing net income by total assets. So the formula is return on assets is equal to net income divided by total assets. So next, return on equity. Second ratio is a return on equity, measures how well a company uses its equity to create profit. Equity represents the ownership interest in company held by its shareholder. So to calculate return on equity, we divide the net income by the shareholder's equity. So return on equity help us assess how effectively companies generate profit of its shareholder based on the amount of ownership they have in the company. And last one is return on investment. This ratio is used to measure the efficiency or profitability of an investment. It helps us understand how much profit is generated from a particular investment compared to its cost. To calculate return on investment, we divide the net profit from the investment by the cost of the investment and multiply by it by 100. So this ratio is helpful in determining the efficiency of an investment and whether it's provide a satisfactory return. Liquidity ratios are financial metrics that indicates a company's ability to pay off its short-term debts obligations without raising external capital. High quality ratios typically indicate a company is well run and fulfill its obligations on time. Here are the most common type of liquidity ratios. So we will discuss types of liquidity ratios. So as he said that liquidity ratios are financial measures that tells us how well a company can pay its short-term debts without needing to borrow money. So first one is current ratio. Current ratio help us assess a company's ability to settle its current debts using its current assets. Current assets include things like cash, money owned by customers, account receivables, inventory, and other assets that can be converted to cash within a year. Current liabilities, on the other hand, include bills the company needs to pay soon, short-term debts, and similar obligations. Quick ratio, asset test ratio. The quick ratio provides a more significant, more straight, quick ratio is a more stringent measures of a liquidity than the current ratio, as it's exclude inventory from current assets. Inventory is excluded because some companies may have a difficulty quickly converting inventory into cash. So the formula is quick ratio is equal to current assets minus inventory divided by current liabilities. So next is cash ratio. This ratio is conservative measures of liquidity because it's assumed that a company may not be able to quickly sell or convert other current assets into cash to pay off its current liabilities. Instead, it's focused on the amount of cash equivalents on invested fund a company has to cover its current liabilities. The formula of cash ratio is cash plus cash equivalents divided by current liabilities. Next is solvency ratio. So solvency ratio, which are financial metrics used to measure the company ability to meet its long-term debts obligations. These ratios gives us valuable insight into company financial structure and risk profile by showing us the proportion of its financing and comes from debts compared to equity. The first solvency ratio we will discuss is the debt ratio. So the debt ratio measures the proportion of a company's total assets that are financed by debts. A higher ratio suggests greater financial risk, as it indicates that a longer portion and the company assets are financed by debts. So formula is debt ratio is equal to total debt divided by total assets. So next is debt to equity ratio, also known as DE ratio. The ratio compare a company's total debt to its shareholders' equity. A higher debt equity ratio suggests that the company has been aggressive in financing its growth with debt. This can lead to volatile earnings due to the additional interest expense. To calculate the debt to equity ratio, we divide the total debts by the total equity. So the last one is we have equity ratio. So equity ratio, this ratio provides insight into a company's financial leverage by comparing shareholders' equity to total assets. A higher equity ratio indicates lower financial risk because it means a larger portion of the company's assets are financed by equity. To calculate the equity ratio, we divide the total equity by the total assets. Now, this is a very important and key ratio, which is time interest earned ratio. So also known as interest coverage ratio. This ratios provide insight into a company's ability to provide insight into a company's ability to cover its interest expenses using its earnings before interests and taxes. To calculate the time interest earned ratio, we divide the earnings before interest and taxes by the interest expenses. So the formula is quite straightforward. Times interest earned ratio is equal to EBIT, earning before income, interest and tax, and divided by interest expenses. Time interest ratio helps us assess a company's ability to meet its interest obligations. A higher ratio indicates better financial health, while a lower ratio may raise some concerns. So, but it is always important to consider that ratio in conjunction with other financial indicators to get a complete picture. Now, valuation ratios. Anybody can explain or can tell me valuation ratios? Valuation ratios, okay. Valuation ratios are used to assess the value of a company's stock by investors and financial analysis. These ratios help us determine its company's shares are overvalued or undervalued. So let's discuss one by one. So first one is a price earning ratio. This ratio compares the price of a company's stock to its earnings per share. It is widely used and quite popular. A higher price earning ratio suggests that the stock price is relatively high compared to its earning, which could mean it is overvalued. On the other hand, lower price earning ratio might indicate that the stock is undervalued. So the formula of calculating the price earning ratio is market price per share divided by earning price earning per shares. So next one is price sale ratio. This ratio compares a company's market capitalization to its annual sales, similar to price earning ratio. A high price, you know, sales ratio might indicate that the stock is overvalued, while a low price sales ratio could suggest that it is undervalued. The formula of calculating the price sale ratio is market capitalization divided by total sale. Then is a price book ratio. The price book ratio compares the market price of the stock on its book value, also known as a shareholder's equity. The book value represents the net worth of a company. A high price book ratio could suggest that the stock is overpriced relative to its book value, while a low price book ratio could indicate that it is relatively cheap. So the formula for calculating the price book value ratio is market price per share divided by book value per share. So dividend yield, this ratio measures how much a company returns to its shareholders in the form of dividends. It is calculated by dividing the annual dividend payment by the stock current market price. So the formula for dividend yield is annual dividends per share divided by price per share. So enterprise value to EBITDA. So the ratio compares the enterprise value of a company which reflects its entire market value. The ratio is commonly used in merger and acquisition transactions. It compares the enterprise value EV of a company which reflects to its entire market value to its earnings before interest, tax, depreciation, and amortizations. So formula is EV divided by EBITDA, again earning before earning before interest, taxes, depreciation, and amortization, is equal to enterprise value divided by again EBITDA. Enterprise value divided by EBITDA. So this ratio provide valuable insight of investment decisions. The dividend yield ratio help assess the return on investment through dividends, while the ratio assist in evaluating company valuations. Also remember that it is important to consider these ratios alongside other financial ratios, metrics, and industry benchmark to gain a complete understanding of a company's financial health and the value of its stock. So any questions so far? Anybody is there? Okay, so next one is financial audit. Financial audit, when company's financial statement and the information that goes along with them are carefully reviewed and evaluated. This is usually done by a certified public or accounting firm or chartered accounting, which is an independent organization that is not part of the companies being audited. So why do we have financial audits? Well, anybody can tell me why? Okay. Auditors important because they helps make sure that company financial statements are reliable and trustworthy. They give us reasonable assurance that the statements are accurate and free from significant mistakes or international deception like fraud. So elements of there are let's talk about major elements of a financial audits. So preparation before the audit begins. The audit team, which is the group of people conducting the audit, will create a plan. So this plan outlines what the audit will cover, what the objectives are, uh, what procedures will be used, and what the audit will take place. So then is an internal control revenue review. The auditors take a look at the company's internal control system. These systems are the rules and processes that the company has in place to prevent errors and fraud in its financial reporting. Auditors review these systems to understand how they work and to help them decide how to proceed with their audit. There are two main, aspects of the audit process. Two main, aspects of the audit process: subtractive testing and the audit report. So, subtractive testing is a part of the audit. It is like the heart of the entire process. During subtractive testing, auditors dig deep into the details of transactions and balancing found in the financial statements. The goal is to verify the accuracy and completeness of these financial figures. Once the audit procedures, including substantive testing, are completed, the auditors prepare an audit report. The report is formal documents issued by the auditor to communicate their opinions on the fairness of the financial statements. The main purpose of the audit report is to express whether the financial statements are presented fairly in simple terms. The auditor gives their professional judgment on whether the financial statements provide a true or accurate picture of the company's financial position and performance. There are four types of opinions an auditor can issue. There are different type of opinions that auditor can issue. Auditor play an essential role, as I said, in maintaining trust and transparency in financial reports. Their assessments provide valuable insight into the accuracy and fairness of financial statements. So let's talk about first one is unqualified opinion. An unqualified opinion, also known as a clean opinion, is the best possible outcome of an audit. When an auditor issues an unqualified opinion, it means that the financial statements being examined are presented fairly and in accordance with generally accepted accounting principle, or GAAP, known as GAAP. So qualified opinion give when the financial statements are fairly presented, except for a specific issue outlined in the auditor's report. The issue could be deviation from GAAP, a limitation in the audit scope, or a lack of sufficient evidence or a particular item. So adverse opinion, the financial statement not presented fairly and contain multiple significant errors. Then disclaimer of opinion, the auditor is unable to complete the audit and issue an opinion due to the significant limitation of scope in the audit. So the limitation could arise from a lack of access to necessary information, incomplete records, or any other circumstances that prevent the auditor from obtaining sufficient evidence or record. Financial audits are essential for maintaining trust and transparency in financial reports. They provide stakeholders with valuable information about the reliability and accuracy of a company's financial statements. So the above four types of audits opinion are unqualified, clean, qualified, adverse, and disclaimer of opinion. Each opinion conveys different level of reliability and signals to stakeholders about the overall quality of the financial statement. So here are some references. If there is any question, anybody can ask me now, or if you have any question, please drop me an email at Yasser drop me an email. My email address is yasser@ukversity.co.uk. So that's it for today, and see you next week for our next lecture, which is about learning outcomes for. So have a good day, and bye for now.